The markets have been volatile, and we're going to talk today on why you shouldn't make emotional decisions on your investment strategies. All today on Your Wealth Health. Hi, I'm Erik Brenner, president and founder of Hilltop Wealth Solutions. Today, Matt Aurenz, he's a private wealth advisor and our director of wealth management at Hilltop Wealth Solutions, joins me. And as you can tell, it's a little bit different setting. We're not in our normal setting today. We are broadcasting remotely. As a firm, we have decided to set up and follow the social distancing and having everybody work from home. I'm here broadcasting from our Mishawaka office, and Matt is in his home in Valparaiso, Indiana. And we're really glad that you joined us today. Obviously, we're in very trying times, and we want to make sure we give you a lot of really good information. So if you're following us on social media, please share us. We're going to share some great information today, as well as in the upcoming weeks. And thank you if you're following us on yourwealthhealth.com. So, Matt, we have seen really a change here over the last just 4 weeks, haven't we?
Great change over the last 4 weeks. Even just the last 2 weeks, it just continues to change on a daily basis. Just trying to keep up with it all is getting a little trying, actually.
Yeah. So, and one of the things we want to stress in this session is, you really can make bad decisions based on emotion. And right. It can be really trying.
Exactly.
So let's take a look at, I know we put together some where we were just a few weeks ago. So if you take a look at the graphics on the screen, a few weeks ago, the Dow reached an all-time high of a little over 29,000. Unemployment was just clicking along at 3.5%, really the lowest unemployment. And I know just in March, we got excellent job numbers and good news about trade wars.
Right. And all of those fundamentals existed, and now we're seeing some of that just be turned upside down. And so it'll be really interesting over the next couple of weeks to see how quickly that data has shifted, which obviously is going to influence the stock market one way or another.
Yeah. And I think one of the things that we want to make sure of that I know you're hearing in the media and press and so forth is that certainly we're not health professionals, and really no one knows when this is we're going to kind of hit that bell curve, right, and get control of it. This was started all from a health perspective, not a financial perspective. We were strong going into this, but obviously with shutting down much of just retail stores and just business in general, there's going to be an effect.
Exactly. We don't want to come across as health experts, that's for sure. But the ramifications of what's going on is obviously something that influences everybody from a health perspective, a financial perspective, a daily lives, just a relational community perspective. And so just navigating that and controlling emotions in your finances is becoming complex. And so we just want to help navigate some of that with you today.
Yeah. So, we're going to talk about, that emotional side, because it happens, so quick that to try to judge when things will kind of get evened out and things come back can really be costly. So I'd like to reference some graphics on the screen, if we could, to talk about, Matt, what if you miss, what if you're out of the market, what would happen? So maybe you can talk about that with our viewing audience.
Sure. The perspective of this graphic is really just demonstrating that it's trying to time the market it's pretty impossible. There's obviously up times and there's down times in the market, and what we've experienced and statistically over time is staying invested really, while it's difficult to do, traditionally pays off well. And so this graphic shows that is if you were to stay invested over the course of 25 years, over the last 20 years, that dollar amount would have grown to around 324,000, and just missing 10 days or just missing 25 of the best days over that same time period drastically reduces your account performance. And so a lot of times we hear people say, well, let's just get out and then we'll try to find a good time to get back in. But most of the time when people try to get back in, it's after things feel good, things feel better. And at that point, we've already seen an increase in the markets, an increase in the indexes, and it's almost too late. And it really becomes cost prohibitive, and it becomes a damaging return on your portfolio.
Yeah, and I know, Matt, we don't necessarily think people should just keep their same risk tolerance. I mean, maybe after we get through all of this, and we will get through it all, after we get through it, then revisit the risk tolerance and a strategy. But right now, just is not that time. If you can hang in there, it's just not that time, because you definitely lose if you make drastic shifts.
Correct. You want to buy low and sell high, and so it's counterintuitive at this point to sell low and turn around and buy high. And to your point, that doesn't necessarily mean that you don't make changes. There's opportunities within your portfolio that you can do to harvest some tax loss, or swap out for a better investment. If one's just kind of been a dog over the years for you. So there's different things that you can do, try to become more tax efficient. But you're right. I mean, just changing things in your portfolio to help going forward is drastically different than selling and sitting on the sidelines.
Yeah. So great points, Matt. And what I want to do over the next few weeks here on Your Wealth Health is, we're going to talk about kind of some emotion and helping you get at least foundationally thinking about it today. And then, as Matt said, there's some, strategy going forward. And what I would encourage people to think about is, think about the destination, not the journey. So many people, if you're retired, or even if you're getting close to retirement, your destination still may be okay. May not be quite as what it was going to be, but think about that. The second part about it is that even though you may be early into retirement or almost retired, you still may have a long time frame. So you have to think about that from a time frame perspective, and really important to just have that in your mind, don't you think, Matt?
I think so. You can get hung up real quick on the being in the now and not still thinking about down the road. And again, we're three weeks or so into this. We don't want to become too narrow-sighted on what that long-term goal, those long-term objectives look like.
Yeah. And so when we think about looking at the past, at least, and this will probably end up, being one of the most trying times for sure, from a health perspective, from a financial perspective, portfolio perspective. But I know we've got some graphics on, there's always reasons to sell. Right. So why don't we just touch on those quickly?
Sure. You look at this graphic and you can see you kind of forget about some of these things that have actually occurred. And so that's really what this chart is showing here. The Greek debt crisis in 2010, the Boston Marathon bombings in 13, Ebola, the Brexit strategy, Trump getting elected. I remember that night the Dow futures were down well over 1,000 points, and the next morning the market was positive. And so and again, not that this is something to take lightly, but it is something that we've been through these periods before, the 08-09 financial crisis, where people thought we're never going to see the end of this. Can the market go to zero? And those are just things that you just get concerned and you have fear. But we've always navigated out of it as a country. We might not all agree on how that's done, but again, if we come together, I think we're going to see some positive growth out of this market. It's just going to sting for a little bit in the short term, and hopefully it's very short term.
Yeah. Thanks, Matt. So have you ever made decisions based on emotion? Have you ever made bad decisions based on emotion? When we return to Your Wealth Health, we're going to talk about that. But before we go to break, I want to bring up some resources that we've made available here at Hilltop Wealth Solutions. You can go to our website. We have a volatility resource center. We have weekly webinars at 3 o'clock every Friday. So you can sign up on our website and join in and hear the latest and updated information to kind of help you think through it. And then on Your Wealth Health, we're going to keep you focused on market volatility. So when we return, we're going to talk about your investing emotions and why you shouldn't base it on emotions right here on Your Wealth Health.
We get a lot of questions about down payment, and it's going to be applicant specific as well as vehicle specific. But the best part is right now, the down payments are as low as I can remember them being, because we have 2 or 3 additional promotions going on right now that different people qualify for. So it's crazy to see. I'm looking at a car going, that's the down payment? There's no way. I do the math again. I'm right. You know, it's just fantastic how low they've been.
Here at K's, we provide premium cleaning services for Northern Indiana and throughout Southwest Michigan. That includes homes and businesses. We do the dirty work for you so you won't have to. This allows you to concentrate on what's more important to you, like family. We offer weekly, bi-weekly, once a month, one-time cleanings, special events, whatever that may be, K's is here for you. We provide top-of-the-line cleaning supplies so you know you're getting the best. To learn more, contact us or right here on Facebook to try K's Way.
Welcome back to Your Wealth Health. I'm Erik Brenner, and I'm joined here today by Matt Aurenz, a private wealth advisor with our firm. And as we are broadcasting remotely because we are practicing the social distancing and what has been asked upon us. And so we have our entire team working remotely, but we're still fully functional. And we're talking obviously about the markets and not making decisions based on emotion, which are really important. If you are following us on Facebook, please share us, click that button. And there may be someone that will be have value in the information, as well as thank you for following us on yourwealthhealth.com. So prior to the break, we were talking about making emotional decisions. And that's what we help people do a lot is walking through what is best for them. And it comes down to those emotional decisions short term can really affect you long term, can't they, Matt?
Yeah, that's very true. You know, it's are you making quick decisions based on where you're sitting today, or are you still focusing on those long-term projected goals and objectives? And so you really have to just take a step back and think methodically through the decisions that you're making to see what those impacts will be long-term.
Yeah, Matt. So, you know, oftentimes we talk to clients and they think maybe that something like this has really thrown off their goals. And it's certainly maybe there's an adjustment that needs to be made. But a lot of times maybe they're still on track and they just need to be strategic. And again, making sure that they're on track with their overall financial plan.
Exactly. That's a great point. You know, it's if you don't have the financial roadmap for your long-term goals, it's really hard to know how much money do I need, what type of investment return do I have to be required of my portfolio. All of those small detail things that can say, am I on track or not on track? And that's really what we're here to help with.
Yeah, some good points. Well, you know, we've talked over the years. We've been doing this a long time about making decisions based on emotion. And we actually have some graphics that we want to share with folks. And so let's talk that through.
Yeah, this is a great one that talks about just the different emotions that people will experience in volatile markets in particular. And I think, the early 2000s, I think of '08 and '09, and then I think of now. Those three time periods over the last 20 years is a lot of what people have gone through. You start with getting encouraged, confident, thrilled. Markets are all-time highs in the middle of February here, and everybody's euphoric. Let's get money in. I need to get invested. I'm missing out on returns. And then all of a sudden you have this downturn in the market where you're getting surprised, nervous, worried, and then you get panic stricken. And I think right now we're probably falling into this panic stricken. And so now is really where the rubber meets the road on how am I controlling my emotions, and am I objectively looking at what happens if I sell now? And again, we're not saying that everybody's situation is going to be the same. You really have to be working with your advisor to figure out, is this a time for me to sell, reposition? What do I need to do? Are there opportunities for changes? Can I reposition to be in a better situation? But you don't want to have this panic-stricken sell and sit on the sidelines and wait to get in when you're back up into that thrilled or euphoric section. And that's traditionally what we see is most investors trail overall market returns because they buy high and sell low.
Yeah, and I think that when you look at the graphics there, we were in that thrilled to euphoric period just a few weeks ago, where people were saying, and wow, we're at all-time highs. I know that there were some thinking that or some feelings that this isn't going to continue. Of course, I don't think anybody really had this in mind as it relates to the market volatility. But there's been a lot of studies over the years, as you said, Matt, that investors tend to do exactly the opposite, and those that are really what they call savvy investors, or people you think about. And, one of the sayings I think about and talk about a lot is, Warren Buffett has a lot of great sayings, and one of them that he says is, to be fearful when others are greedy, and to be greedy when others are fearful. And many of those well-known folks that have invested over the years and done very well, they're thinking about this now from an investment perspective, and when's the time to actually start buying. And I think about back in '08, '09. I can remember in March of '09, the Dow Jones was almost 5,000, and some people thought it was going to go to zero. And look where we went. We just talked about reaching a high of 29,000 in 11 years.
Right. I kind of think back to my freshman year of high school econ class, learning about opportunity cost. And, this is a perfect opportunity where people don't want to have that, 2012 moment where they're going to say, boy, I wish I would have bought this stock, or I wish I would have bought that stock. It tripled, it quadrupled. If I would have only put money in, but boy, I was just really scared to do it. And so I do think that, those opportunities are going to present themselves. You don't want to just be irrational or just throw money at something. You got to be wise about what you're potentially investing in. But you have to weigh the costs, and you have to weigh the opportunities and say, hey, where can I reposition some things, or where can I free up some cash flow, or can I take a little bit of savings? And with so much uncertainty, you just need to talk that through with somebody.
Yeah. Thanks, Matt. So making decisions and maybe taking some advantage of where we are today. We're going to talk about that when we come back with Your Wealth Health. But before we do, we want to make you aware of some resources that we've put together. If you go to hilltopwealthsolutions.com, we've got some market volatility resources, and we're continuing to update that with information, as well as we are hosting weekly webinars, 3:00 every Friday. We encourage you to join us. You can sign up on yourwealthhealth.com. And we always are there to take a 30-minute call to just talk through your situation and help guide you along the way. So stay tuned. We'll be right back on Your Wealth Health.
The day is breaking softly and the night is glowing true I feel a million eyes, but I can just see you. No rain, no thunder, it's just your light, your voice, the heaven of our kiss, the wonder of our choice. So breathe, 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 darling, you can make my love your home, make my love your home. And please, please, darling, do. If you can be right, make my love your home.
Welcome back to Your Wealth Health. I'm Erik Brenner, where I'm joined today by Matt Aurenz, and we are remote because we are practicing social distancing, and we want to make sure that we're helping out. We want to really shorten this period of time and get people healthy and get our economy back and going. So if you're following us on Facebook, thank you. You can share us, and I think a lot of people would get some good information. You can follow us on LinkedIn, and you can also follow us on Your Wealth Health. So, Matt, we really believe in focusing on what you can control, in your investment strategy and your overall financial strategy.
Exactly. You can worry about the things you can't control, or you can pay attention to the things you can control. And so some examples of what you can control: spending patterns, what those habits look like. Are you paying extra on your mortgage? Can you reduce that down? Right now, I know for me, I'm not going out to out dining and spending a bunch of time at restaurants. So doing a little carry out to help some local businesses. But beyond that, what can you control in your spending habits? What can you control in your portfolio? Those types of things are really going to help set the stage and maybe even recreate or help build a way for you to have better spending habits and savings habits going forward as we come out of this crisis.
Yeah, and I think we'll talk about that in future episodes. But as you said, savings habits, Roth IRA conversions, opportunity there. Accounts are down right now. Get them possibly into things that will be tax free into the future. And so really, what can you control? And one of the things that I think about is it's important to not let the emotions get in the way, because we already talked about this, but we really wanted to talk a little bit more in depth if you miss the upsides in the market. So why don't we take a look at the graphic that we have on the screen?
Yeah, so this one is, again, if you keep things in perspective, you can say, what I can control is keeping my money invested. And what we found is that the 12-month period after the markets have had decline, there's traditionally some of the best up years you've ever experienced. And so you don't want to miss that. You don't want to be short of that. Even 2018, I remember the fourth quarter, people were thinking, okay, here's the final drawback in the market. We've been waiting for this correction. And then January through December of 2019, we saw a 37% increase in the S&P. Same thing coming out of 2011, 08, 09 financial crisis. Markets were down 56% in that 3-year time period, and the following year up 68%. So again, it's you can control being invested. You have to be smart about it. Don't get me wrong, but you can still control that, and you don't want to miss that upward swing, or you'll most likely regret it, and it'll probably hinder your long-term financial success.
Now, there is a point in time, I think, where folks really, it's just really feel uneasy. It's just not a position that they can take as it relates to volatility. And how should they think about that?
I think that's a good point. If you're losing sleep over this, if it's just that's all you think about, you're checking your accounts on a daily basis multiple times a day. You probably will definitely need to readdress. All right, should I continue to stay invested, or maybe I pull a little bit of the money out? Something to calm your nerves a bit. You don't want the stress of this to cause more long-term financial health for you. So you have to pay attention to those things. We are realists here. You know, I even this is what we do for a living, and I even sometimes think, okay, should I pull my money out? What should I do? And then just reminding myself, stay the course. But again, if you're one of those people losing sleep, I would encourage you to talk to your advisor.
The other thing I think would be important just to address quickly, and we can talk about it in future shows, but I've had some conversation. Couple clients have asked me, does this change the way you kind of think about investing in the future, and trying to not go down as far, and all of these types of things? And I think the answer is yes. This isn't the time to think about that. But I think for us in providing advice, we're going to look at this in our industry and in our guidance going forward differently.
Exactly. I think of when we came out of the last down market, we really addressed what we own in our portfolios, things that are 100% correlated to each other. Does that really provide diversification? So we really kind of redeveloped and recreated our investment philosophy on some things. And, I even remember last October having conversations about, let's take some risk off the table. And, for the next 3-4 months, we just saw the market go up, and I'm thinking, okay, well, maybe that was a poor decision. And here we are. So it can happen at the snap of a finger. And so, yes, I do think that it will continue to navigate and pave a way for what investment strategies look like going forward. But you also have to give some time for things to work and see, how do they hold up in down markets? How do they hold up in volatile markets? Theories are always there, but until a theory is tested, we really can't have good factual data to make investment decisions.
Yeah. So that's exactly right. Making that decision today would not be a smart thing overall. So, yeah. Well, any last thoughts, Matt?
Just continue to readdress your goals. Continue to talk to your advisor about making the decisions. That's about it.
Yeah. Hey, Matt, thanks for joining me remotely today. And I know we're going to be doing this until we're told that we're safe. So thanks a lot. And thanks for joining me today on the program. We do have some resources for you. First off, you can go to hilltopwealthsolutions.com. We have a 30-minute free call that we'd be glad to take and talk through your situation and kind of help you think about things. As well as we have put together a resource center. You'll find that on the website. And we will continue to update and give you information there. We do have a weekly webinar that brings you up-to-date information. Our advisor team is on the webinar. We'll talk through strategies and where things you can think about. And then we'll continue to provide information here on your wealth health. So make sure you join me next week right here on Fox Michiana, and we'll bring you even more information about what you should think about and how you should think about the current markets and where you're going with your retirement plan and other plans. For Matt Aurenz, I'm Erik Brenner. See you next week.